Now, as we mentioned, you couldn't pick between two, so you've brought us another company. What is it?
I have. The company's Better under the code BB2, and I'd like to think a bit of a misunderstood or hidden gem again. It's an online wagering platform that was actually formed. Its current formation was a byproduct of a reverse merger last year, where you had the Bluebet business, which was an existing ASX listed company, merged with Better, which was a private company, which has now become the senior partner in the management team and board and shareholders are really driving the outcomes now. So, real hidden gem from my perspective and not well understood, especially with some recent developments over the last 3 months.
Well, let's go to Better, shall we? We've brought CEO Andrew Menz into the event, and he's joining us from far-flung travels somewhere, I believe in California. Andrew, welcome to Small Caps, Big Ideas. So to Greg's point, you've sort of guided Better through the merger with Bluebet, and I've got to say a pretty strong FY25 result. So how is the transformation going? How is the integration going? Have you been hitting your early targets on that front?
Yeah, for sure. We've been super pleased with the merger and then the results of customer migration. We had that all wrapped up in about 3 months from when we had the merger done. We beat our synergy targets by north of 20% and had a really strong operating performance underlying following that integration. So it's a model we've used before in this category, and it really does. It is a scale game, the wagering industry, and we've now got that scale through the merger with Bluebet to take us forward.
Yeah, thanks, Andrew. But Greg, Andrew mentioned scale there, technology as well. So with that combined scale and technology, how do you see Better positioned against its competitors? Because it's my understanding that this is a very competitive space.
It is, absolutely. And what excites us is a combination of the consolidation that's going on in the sector at the moment and the team and balance sheet of the Better business. So if you start with the team of Better, you've got, obviously Andrew's a great leader of the business, but on the board as well, you've got very well-known industry, call them veterans, proven experts in Michael Sullivan and Matt Tripp, who have, been involved in some of the larger consolidation and success stories in the sector over the last decade. So got a really strong, well-connected, proven team, and couple that with a strong balance sheet. So recently there was a bit of a takeover battle for the PointsBet business. As a result of that, the Better business is sitting on a 27% strategic stake in that business that it is worth north of $60 million. In addition to that, you've also got a cash war chest as well, which enables them to be a really strong player in further consolidation. And there are a number of opportunities that continue to present themselves. But what really interests us is that's a potential catalyst down the road. But underlying all that is masking a really strong operating business that if you take out the value of those strategic shares they hold in PointsBet and the cash balance, you've got a strong high growth business with a market leading position that's trading on a single digit earnings multiple. I think people have lost sight of that through the last 3 to 6 months and creates a really interesting opportunity. Yeah,
Andrew, a lot of our viewers would be familiar with Better through that proposed takeover of PointsBet. To Greg's point, you are now pretty hefty on the register. So just tell us, how do you leverage that in practicality to drive value for shareholders?
Yeah, it was quite a long and drawn out process. The PointsBet scenario, ultimately, the Japanese firm Mixi has acquired 2/3 of the company, and we're sitting on 27%. We really like the PointsBet business. We like the fundamentals in the business. We think the technology is excellent. And as we spoke about before, this is a game about scale. So there is an opportunity, and we believe the right opportunity in this market still is to combine Better with PointsBet or other similar businesses to really leverage the technology spend, the R&D that we've put into the business, and leverage off a pretty significant marketing investment as well. So we're still keen on working with other shareholders to see whether we can get that combination together, and that would be a really, really successful, profitable and high growth business.
So for FY25, earnings of $7.2 million on turnover of about $1.4 billion. Can the momentum continue? I suppose importantly, where do you see margin expansion opportunities?
Yeah, so definitely the growth can continue. We're really pleased with 25. You know, it was a burner to earner year for us. So we've now proven that we can generate free cash flow, and we'll continue to do that going forwards. We had a really strong first quarter as well. Our quarterly results will be out in a couple of weeks' time, but the momentum from FY25 continued into that first quarter, despite the market having some challenging sports results, particularly in some of those NRL finals. We were again able to achieve our target net margin, and I think that means looking forward at margin expansion. It's new products, it's the right customers, and it's really personalised offers. And we continue to invest really deeply in our data, our technology, and our CRM to make sure that we're being really efficient, and we are driving margin expansion from the turnover that we're having come through the business.
Yeah, I think it speaks to the competition as well, Andrew, that you need to continue to innovate and invest in the business itself for growth. So how are you balancing, the competing priorities for the business going forward?
Yeah, that's always been the challenge in this game. Ultimately, we hold the view, like most others do, that product will win in the long term. It won't be about who gave out more free bets or what promotions were on the weekend. It will be about providing a customer experience, a digital customer experience that rivals those of the leading tech companies throughout the world. So we invest very deeply in our product. We've had a few first-to-market features out in the last quarter, including a sort of takeover on people's homepage of their phone, updating them on live scores or the status of their same-game multis, for example. So we're starting to innovate and try and bring those amazing digital experiences to our customers. And we do believe that's the way to compete and win in the long term here.
And I have to ask about the overseas markets, given your location. How do you see Betr being able to leverage how regulation and government policy is changing in, say, the States, for example?
Yeah, we've made a decision at Betr to be laser focused on Australia. We've got a long track record in the market. The market's a significant one. It has returned to growth in recent months, so we're really, really focused on Australia. The reason for being in places like the United States, though, is to take some learnings from the product development and the innovation that's going on in the market here. And we're seeing rapid market expansion across the US. And with that comes, brilliant new customer experiences, different ways of thinking about things, and their learnings that we can leverage and bring back home.
Yeah, so Greg, in FY26, Betr is expecting a return to growth for the Australian wagering market. As an investor, are you happy with that laser focus on the local market?
Yeah, absolutely. I think, as Andrew touched on, first and foremost, you need to operate well. And our observation through a lot of deep research and comparative analysis is these guys got the best operating metrics in the market, and so net win margin over 10%, and then again their adoption and use of technology and systems within their business enable them to be quite efficient in what they do as well. And so that's something that's really impressed us, and that was really showcased with the recent acquisition of Top Sport, which was a competitor that they acquired. Within 6 weeks they'd fully integrated that business onto a centralised platform, and we're extracting the synergies from that. But result of that and some other couple of smaller acquisitions over recent 12 months, they've got a lot of customers that they can convert as well onto the common platform as well. So they're not necessarily out there looking for new customers all the time. They've got existing customers they're looking to convert over. So you get those revenue synergies come over time, but the cost synergies are banked really quickly. And so again, I think underlying this business is great systems and great processes and people that drive good operating metrics, and that's the core of everything. When we talk about the catalysts and potentially transformational events around mergers and acquisitions, they're nice to haves. The others are the must to haves. And again, I think that's what people have lost sight of, is that this is a best in class management team with best in class metrics that is trading at, again, you take out the cash and the strategic shareholding, this is on a single-digit earnings multiple with some of the best metrics in the business. And if you contrast that to where all the other transactions are happening in the market, there's clearly hidden value here. And I think 26 will be a great year to showcase that. And I think as the fog clears from the noise of the PointsBet dance, people will start to focus on fundamentals again, and that's the opportunity we're excited about.
All right, Andrew, in your words, you say that you're committed to driving shareholder value. So what can shareholders expect? What's a catalyst to drive that value going forward?
Look, it's all about scale, and I know I keep talking about it, but we have an ambition to get to 10% of this market, and that's organic, and we need some inorganic growth in that as well. So whilst Greg is spot on that the operating business and that is absolutely fundamental, but we're out there for growth to really leverage our the technology, the platform we've got, and the team we've got by putting more turnover through it. So we'll continue to look for acquisition opportunities, partnership opportunities in the market, and we do believe to become a 10% of the market, you become profitable at scale. It assists that operating leverage, it's deeper reinvestment into marketing and product, and better returns for shareholders. So we are focused on profitable growth and making sure we get to the scale where it's sustainable and will drive long-term shareholder value.
Andrew Menz, thank you so much for joining us on Small Caps Big Ideas. We appreciate your time.
Thank you for having me. Appreciate it.
Thanks, Andrew.
Greg, so a couple of hidden gems for us. Just on Andrew's last point, as an investor, a manager, you don't necessarily need companies to be profitable before you allocate capital?
No, not necessarily, but there needs to be a good reason why they're not profitable. And in our mind, a good reason is if they're growing at a rapid rate and the long-term growth metrics justify that spend. i.e., are they acquiring customers at a reasonable rate and retaining them, and the return metrics on that customer acquisition justify the spend. And then there's other businesses, which I've spoken about before, like technology businesses that are spending money on building their platform that generates, long tail opportunities for revenue, and they might be expensing that capital spend. So they're the kind of excuses that we accept for loss-making companies, but ideally back to we're looking for profitable, growing companies with strong balance sheets, great management teams, and that are undervalued. And so it's more an exception to the rule that we look at unprofitable businesses, but sometimes that's the opportunity.